Yeah.
If you can even break even, it's an anomaly for these out-of-town buyers. And there's a lot of money in the GTA. There's a lot of people looking to put money to work. They can't do it in their home market. They're just looking for the next place to go. Windsor's on that map for now. And not only, we always talk about this as well, but not only the investor, but there's also people that are just feeling the same way. Hey, I make $250,000 a year. I can't even afford to buy a single-family detached home in GTA. I work from home 99% of the time.
Right.
I'm going to another city. What's up, everybody? Scott Ascenti here with Pritish Raval, back with episode somewhere between 10 and 15 of Leverage. Tons of news to talk about today. Pritish, you and I were just talking before the show. You were telling me that you are possibly disappointing your daughter this weekend, double booking yourself. You can't take her to the carnival. What is that about, man?
So school's done today. Today's the last day of school. Friday, I said to her, afternoon, we're going to get the other kids out of daycare and we're going to go to the carnival. And I've double booked. I've got client meetings. So I'm going to try to see if I can get the client moved into earlier in the day and go to the carnival to...
You got to get her to that carnival, man. Because especially if it ends Sunday, that could be your last opportunity.
No, yeah, I have to go. Every time we go to the carnival, we always play games. And I've yet to lose a game. And I've always won a prize for her.
I don't believe this story at all.
It's a true story. Went to the carnival Strawberry Fest last year. Won a pink donut. Like a stuffy not to eat, like a stuffy pink donut. She loves it. She still remembers every time.
Oh, yeah, you got to get her to the carnival. I remember one time my dad promised me the carnival, bailed on me in the last minute. I still haven't forgiven him. That was 35 years ago. So you got to get him there. Got to get him there.
Yes, I'll there.
So we were chatting before the show here, just on what's going on in the market. I think some sellers, especially the investor clients, are starting to reach the brink where they're really feeling the pinch of the higher rates. The cash flow's gone. They're on variable mortgages. They're bleeding money every month. My phone has picked up over the past, let's call it month and a half, but more so each week as we proceed with my investor clients looking to sell.
Okay. But are you getting more calls from investors, would you say, than just like any other client to sell?
Yeah, I think, yes, definitely. I think the average buyer or seller is more concerned. They're not necessarily trying to time the market. They're more concerned with what can I sell my house for and what do I want to buy? Do the numbers make sense? They're not necessarily as dialed into the market and trying to predict it as the investor clients are. So, yes, it's been an abnormal couple of weeks here with the investors looking to sell. That could be an interesting opportunity depending on your perspective in the next 6, 12, 18 months. I don't think most people really felt these rate hikes as much prior, right?
It takes there's a lag, right? There's a lag. And so, I think one of the things I was reading up on, generally the payment increase is anywhere from 25 to 40% on your mortgage. So it's a pretty good chunk, right? If your payment goes up by 25 or in some cases 40%, cash flow is probably going to be an issue if you're an investor that was in a variable mortgage product, right?
Yeah, now to be fair, the rents are up probably a similar amount in that period of time, I would say. But as we know, in Ontario, socialist province, you can't raise the rents more than they allowed us, like 2.5% this year. So you can't keep pace with the inflationary pressure and the interest rate pressure. You're now bleeding cash. If you could get up to market rents, you'd probably be okay. But the policies here, and there's actually a study that I was reading through. Somebody posted the rent control impact on San Francisco's market, one of the most popular markets in the world. They found that the rent control that the city put in place actually led to much higher rents over a long period of time, which I strongly agree with. Now, because the point here, right, I like to try to think 2 or 3 levels deep. I don't like to just look at the surface of what I'm reading. I want to think beyond the surface. And immediately what I think is, okay, you're going to sell these investment properties. Probably more than likely regular buyers are going to come and buy them, looking for a house to live, which is great for the resale market.
Right.
But I'm telling you what, there's going to be even more significant shortage of especially single family rentals, which a lot of people, they can't live in a condo.
Right.
Okay. You've got 4 kids, you got 3 kids, you're not living in a 2-bedroom condo. It is going to put increased pressure on the rental market. It's going to make rents more expensive in the long term. And this is not fixing the problem at all, which is there's a significant housing crisis in this country. I want to emphasize to people that this problem is not being fixed with lower prices and higher rates.
Right.
It's probably making it worse not only for the rental market, but for the resale market, because builders are not building right now. I don't want to harp on that too much. I talk about it every episode, but what are your thoughts on that? Like, can you see where I'm coming from, where I just think that, man, people are going to be hurting on the rental market. It's already pretty tight.
Yeah, for sure. I mean, like what you just said, that's a great point where a lot of your clients right now that are investors are trying to sell their properties. So that kind of tells me pretty much everything I need to know is that, they're the first ones to sell, right? People who are owning as primary residents, their mindset is totally different. They're more thinking, if we're going to sell, what are we going to buy? What are we going to qualify for? So I think it is going to create an opportunity. If you're an investor, potentially it's going to create an opportunity. So if you got investors looking to sell, maybe it's a desperate sell. And so if you're an investor waiting to get into the market, you can get in with that fear, right? Because the rates are going up. Everybody's on the sideline waiting to see what happens. That fear is also going to create an opportunity. So, I think it creates an opportunity as well.
Yeah, and I'll say we're not there yet, right? This is it's an early indication that this could be a continuing trend moving forward. And to be clear, like, my personal perspective, if you have a single family home and your cash flow negative $100 or $200, and if you could weather that storm, you have a great income, you're not really hurting, you're not over leveraged. I don't necessarily recommend selling, right? Especially when we have so many catalysts here. And I can see, like, single family home is never really a cash flow play. It's more of a long-term buy and hold appreciation play due to the replacement cost being so high.
Right.
The long-term fundamentals of our market here, whether in Ontario or Windsor specifically, are very strong still in terms of supply and demand, in terms of job growth and population growth.
Absolutely.
I don't necessarily find myself rushing out to sell my properties unless, of course, you're in financial trouble. That's a different story.
Right.
So there's, don't take this as any sort of advice, or we're recommending rushing out to sell properties. Long-term fundamentals are still very solid. Now, hopping on to the next topic, we were kind of talking about the new OSFI rules. What the heck is that acronym, by the way? I have no idea. So,
yeah, a lot of people say OSFI. It's actually OSFI.
Okay, yeah.
OSFI.
Good to know.
The Ontario Superintendent of Financial Institutions. Okay. So OSFI, so they kind of regulate the banks, right? They've been around for a long time, banks, credit unions, and everything. Going back to acronyms, I agree. It's one of the weirdest acronyms to say OSFI.
It's not natural.
Yeah.
It's unnatural.
Maybe you should be, Superintendent's Office for Financial Institutions, like
we should write a letter.
SOFI or SOFI.
That makes much more.
I feel like that's easier than OSFI, less of a tongue twister. CIBC is the bank I work for, so that's a pretty easy acronym, but people still sometimes say like CBIC or CBC. Yeah.
So painful.
Yeah. But going back to OSFI, yeah. So there was a few articles that were released last few weeks, and one of them focused on them requiring the banks to have a higher cash position. So they'll do this, periodically. They did that, I believe, a few quarters ago, or even last quarter. This quarter, they're again requiring an increase in the cash position, pretty much meaning, the bank has to have enough money in cash that's not owed to anybody else in the event, if people are delinquent in paying back loans or mortgages, so that they can protect the deposit clients and the rest of the shareholders as well.
Yeah, so typically banks would either, take that money and lend it, or maybe purchase securities or bonds with it. I'm not 100% sure, but they might have that cash, not necessarily in cash, but in other investment vehicles.
Exactly.
Now the OSFI is saying you can't do that. You have to actually have the liquid cash on your balance sheet because there's increased risk in the system. Extra cash on the balance sheet means you're going to have tighter lending standards because you're not going to have as much money to lend. It's going to be harder to get money. Yeah. And here's, again, thinking 2 or 3 layers deep, yes, it's going to have a significant impact on the real estate market and the investment market and all that stuff, but it's also going to have a significant impact on development market, which we're in much need of. Like, nobody's going to be building in this environment. The capital, the borrowing costs are significant. Prices are suppressed. Demand is suppressed and affordability is suppressed because of these tighter lending standards. Builders are going to be on pause. I just foresee this exasperating the housing crisis. And if and when we come out of this, whether it's 6, 12, 18, 24 months, I'm not trying to predict the time, we're going to find ourselves in a situation where this supply-demand imbalance is probably even worse than it was now.
Yeah.
Now, if you'll notice, usually if I'm buying an investment property or thinking long-term, I'm usually factoring in 2 to 3% appreciation on real estate per year. That's about the rate of inflation. I don't try to predict 5, 10, 15%. That's just crazy. So I will say that we might see an average, right? If you take a chart and spread it over 100 years, somewhere between 2 and 4% appreciation compound annually over that 100 years.
Yeah, that's more organic anyways.
It's normal. It's natural, right? It's inevitable. Now, we might be in a time right now where the chart goes like this and then a dip for a year or two. I don't know where we are in this chart, but long term, I'm going to expect that graph to go up and to the right, as it always has and always will, because of the financial system we're in, because of the population growth, the difficulty to replace real estate, the costs associated with it, the shortage of labor, all these things we're talking about. So if you take a $300,000 house compounded annually over at 4% or 3% over 20, 30, 40 years, it's significant growth.
Absolutely.
And these homes are going to be 5, 6, 700,000 at some point. It's just the way the monetary system works.
It's funny because we were golfing at that charity tournament not long ago.
If you want to call it golfing.
Well, I was golfing.
That's debate.
Played fantastically. I might have set the course record.
But the lower scores are better. Right?
Oh, that's how golfers. Thanks, Scott. We're at the course, surrounded by beautiful homes, right? And so, you look at those home prices right now. They're about 1 million, 1.5 million, maybe in that range. And we were just talking within our group, and it's like, it's going to be funny. We're going to look back in 20 years from now. We're going to be like, oh man, we could have bought that for 1.5 million. It's probably going to be worth more than double at that time, right? So
it's inevitable, and people really don't understand the monetary system we're in. Like, it all comes down to that. The monetary system will continue to increase in supply of money, right? There's always going to be money printed. We might be in a money contraction time right now, right? Which could last for a year or 2 or 3, we're not sure. But eventually, like, the money printer will always go on. It's just, it's a fiat currency. It's based on nothing. And as more and more money enters the system, it drives up the price of assets like real estate or other hard goods. So the growth is inevitable, and the money supply, let's say it even increases at 2 to 4% a year, which is below average. That's going to mean you can tie that to an asset price and say, well, that means real estate's going to appreciate at a similar rate. Now, when you come to like premium assets, like sitting on the back of a golf course, those appreciate typically higher than the rate of inflation because they're so limited and so desirable and such a niche product and hard to replicate that if the average inflation is 2%, those are appreciating at 3 to 4.
Yeah, I decided to put in an offer on like 3 or 4 of them.
Nice.
Because I want to buy like a whole street now.
Okay, well, I don't know are you pre-approved?
I need a mortgage guy.
Yeah.
If anybody's looking for.
All right, good stuff.
But one thing about going back to the investors, one of the things I noticed is I actually started. I was just in Toronto not long ago, and a lot of realtors there are also marketing clients and find investment properties in the Windsor area. So that was a bit of a surprise for me. Like, I wasn't really expecting that. They're actually driving their investor clients to invest in Windsor because it is still one of the most affordable in Ontario.
People underestimate the impact of out-of-town buyers and the impact on the market, because you cannot find, this has already been going on for 3 or 4 years, right? Now it's maybe a little bit more obvious. If you're like, I've been in the game, so I've been seeing it. You may not have seen it as much, but yeah, the agents, literally, I was shopping one of my multifamily properties, and an agent is like, can I do a TikTok video on your property for my client base in Toronto? And I said, yeah, have at it, right? Yeah. And he's on social media marketing specifically Windsor, and he's driving down on weekends to show multifamily properties. Yeah. If you can even break even, it's an anomaly for these out-of-town buyers. And there's a lot of money in the GTA. There's a lot of people looking to put money to work. They can't do it in their home market. They're just looking for the next place to go. Windsor's on that map for now. And not only, we always talk about this as well, but not only the investor, but there's also people that are just feeling the same way. Hey, I make $250,000 a year. I can't even afford to buy a single family detached home in GTA. I work from home 99% of the time.
Right.
I'm going to another city. Yeah. And then you drive until you find a house that you like. Oftentimes that is somewhere like Windsor. So
exactly.
The fundamentals of Windsor are so strong. The only negative factor that I can actually point to right now is interest rates and cost of borrowing, which is significant, but we like to theorize that it's temporary. Because one of two things are going to happen. Either they're going to back off the monetary policy at some point, right? It might be 12, 18 months away, I'm not sure. And they're going to start to dip rates. Or the market's going to come into balance again. Borrowing costs are going to come to meet the new affordability levels, and home sellers are going to come down to meet the new levels. And then the game's going to continue on, which is a slow and steady rise. We don't know when or at what price point that will be, but come talk to me in 100 years. I'll be dead by then, but come talk to me if I were alive in 100 years, and you're going to see, just like what you said, housing prices have doubled. Yeah. And we're going to look back at today's prices and say, wow, what a deal that would have been. Yeah, exactly. It's the same story every 10, 20, 30, 40 years. So
speaking of rates, because you had just mentioned it, we probably are going to get one more rate increase before the end of the year.
Sounds that way.
And then I think they're going to hold until we can get inflation down. I mean, there was a drop, we were just talking about that drop to 3.4%. So, I think they're going to increase and probably hold.
Yeah, and there was an economist that predicted this. I think when they did their last pause, like January, February, March, one of those earlier months, an economist came out and said what's likely to happen is they're going to pause. That's going to spark an asset relief rally, which is exactly what happened. As soon as they paused, the market went nuts.
Yeah.
So then the asset relief rally takes place. Then they have to come in with another dose of rate hikes to quell that. So he predicted this at the last pause. And I've been kind of saying the same thing. Like, as soon as they lay off the gas pedal, the market's going to go nuts because the fundamentals are so out of whack. So they've realized, hey, we haven't squashed inflation yet. We haven't squashed it, and we need to, right? So they're doing the right thing. I'm gonna say that. But it's almost like if there's a blazing fire, the firefighters come in, they blast water on it until the fire comes out. And then you might see a spark or some ashes, and they come and blast another dose on it. But they don't sit there and dose water on it infinitely. Right. They do it until the fire is out. And right now the fire is not quite out, and they're trying to stomp it out. The inflation print was lower. Yeah. Core inflation still running sticky, which is obviously problematic. But the thing people don't understand is that a lot of the policies, right, like the carbon tax, is very inflationary for core inflation, because all the producers that are shipping food and groceries from around the world, right? We're importing stuff from all over the world. If you got these taxes, it's just increasing the price of everything. So higher rates aren't going to fix everything, and they probably know that. Yeah. So we'll see how it all plays out. I'm not in the business of predicting interest rate cycles. We're just here kind of reporting on it.
Yes.
We don't know how it's going to play out, but we can, long term, I'm pretty confident saying that real estate prices are going to rise at a nice, slow, steady pace. If you can weather the storm, weather it. If you're not in the game, be opportunistic.
Yeah.
And if you're selling assets now, sell, raise money, and look for opportunities.
Reinvest, right?
Yeah. We might be at the early stages of those more opportunistic times as people start feeling the pinch a little bit more. So yeah, great episode here, man. Make sure you get your daughter to that festival. I want to see proof of you winning all these carnival games. I still don't buy it. Those games are hard, man.
It's with the whack-a-mole.
This guy's mortgaging his house to win these toy donuts. So costly. How much you lose there?
It's $5. Won it first shot. First shot. Let's go.
Okay, buddy.
I'll put it on Instagram. Check it out. Mortgage.mastermind. All right. There we go. Yeah. There's the plug.
Love it. All right. So we'll be back in 1 to 2 weeks, and look forward to the next episode.
You got it.
Awesome, man. People underestimate the impact of out-of-town buyers and the impact on the market. The agents, literally, I was, shopping one of my multifamily properties, and an agent is like, "Can I do a TikTok video on your property for my client based in Toronto?" And I said, "Yeah, have at it," right? Yeah. And he's on social media marketing specifically Windsor, and he's driving down on weekends to show multifamily properties.